Hey guys, Ben from Pivot, and today I'm bringing you the money news in human words, where I'll be unpacking the key sort of measures behind the headlines and what you need to know to make smart money choices. Now, there's a ton going on at the moment in the news, and I think a lot of people talking about the economy, property, investments, where things are at, inflation crisis, and the rest. So I thought a good place to start is bigger picture, looking at the economy, and in particular the job of the RBA to bring off what they're calling this soft landing, which essentially means finding a way for the RBA to basically stop inflation, but without killing the economy. Now, there's a lot of good things that are happening in the Australian economy, put us in pretty good shape and much better shape than other countries like the US and Europe in particular. We've got a lot of strong fundamentals, but we do have this real problem around inflation. So the idea and what the RBA is trying to do is to wind back on inflation without forcing business to slow down too much, the economy to slow down too much, and without therefore unemployment from going up too much. So a lot of commentary that came out last week around this from a whole bunch of different people, but the NAB's chief economist, a guy by the name of Alan Oster, he put the odds of the RBA pulling off this soft landing at about 60-40. But he said that the biggest thing for him to feel like we were going to pull off a soft landing was that the interest rate didn't go much above that 3% mark. We've got other people talking about a 25% chance of a recession. We've got Alexi Gray from Vanguard talking about it being a 50-50 chance in Australia. And so obviously it's a bit of a mixed bag here. I think that the main measurable of this is really unemployment and economic growth. They're the two, with experts talking about the unemployment in particular having to increase from this record low that we're seeing at the moment of 3.4%. Inflation and therefore interest rates is the big thing that's going to drive how and where we get to with this, though. So I suppose the big question is how far the official interest rates are going to need to go to curb inflation. We're still forecasting that that's going to peak at 7.8%. Is the really big question that needs to answer. Now, they did this big poll, and I suppose this is where a lot of this is coming from last week, of the 20 leading economists, and the predictions around where the cash rate was going to go range from anywhere from 2.6% up to 4%, with the average being 3.1%. And look, every single one, with the exception of one, Paul Brennan from Suncorp, predicted a fourth 0.5% interest rate rise at next month's RBA board meeting, which is in just a couple of weeks' time. So a lot of mortgage holders are probably thinking like that these 19 people are wrong, but it's seeming like the consensus is that it's still going up at a pretty substantial clip. I think everybody agrees that it is going to keep going up, myself included. It's just a question of how quickly and how much. So the July and jobs data came. July jobs data and the June quarter wage data came out and didn't really change the picture. Basically, the people that were thinking negatively about the economy felt that they were justified in that as a result of the data. The people that were feeling positive felt like it was that was justification of their thing. So I suppose it depends on how you read the data that's there. But we did see a private sector wage growth of 3.8%, but annual wages across the country is 2.6%. When adjusted for inflation, real wages have gone backwards by 3.5%. So that's to the data to the end of June, but that data does not include the big increase to the minimum wage of 5.2%. 2.4 million award wage workers have had a 4.6% wage rise. So those things will filter through, and we're seeing more and more awards negotiating these decent wage jumps. And overall, obviously, that contributes positively to wage growth. Public sector is a drag on wages, and we saw public sector wages only grew at 2.4% over the last little bit. But yeah, more data is coming in on this. And I think that's an interesting one to watch. Higher wage growth can lead to more inflation, can lead to higher interest rates, lower wage growth, lower inflation, lower interest rates as well. Changing, I suppose, changing countries now, but with the same theme, and looking at US, and they're talking about the recession fears easing over there as well. A lot of their corporates have been reporting their profit data, and particularly companies like Walmart, who are a real sort of bellwether or measurement of how things are tracking for the economy. They just posted their earnings and showed that consumers are still spending. In Australia, we're seeing similar trends where super retail groups showing massively strong profit off the back of this record low unemployment. We're seeing record low unemployment in the US as well. So people are still out there spending, and that's what drives economic growth. So when people pull back, the economic growth slows because people aren't spending money with companies. Companies aren't making as much revenue. Things start slowing down. So we're seeing that high inflation, and because people aren't slowing down spending, that means that inflation is essentially continuing to increase. So it sort of sounds good, but the flip side of it is actually bad. So we've seen that continue over the last little bit. Because interest rates have increased dramatically, but only over the last 4 months, we're sort of really yet to see the impact, particularly because the banks take a little bit of time to actually roll out interest rate increases. So it's only that really that those things are starting to kick in now. And I think that the coming months will be a real test. Obviously, with talk and the high likelihood of interest rates continuing to increase like next month and in the following months, so that's the really tricky thing, going back to my previous sort of focus area, that is a challenge for central banks, the RBA in Australia, Fed in the US, that if they keep pushing it too far and then things kick in, then they could have overreacted and need to cut quite quickly. Similar theme, talking about Australian company profits, that over here, that similar to the US, that the higher rates aren't impacting consumers, at least for now. Companies are making money. It seems that they've got drawn in a lot of commentary from experts and economists in particular, and saying that it feels more like a slowdown in Australia that we needed to have rather than a recession. And that also there were a few comments about people trying to, it feels like almost like people trying to talk themselves into a recession. But that being said, many companies are cautious with a lot of the companies that have reported into the recent reporting season. Also, a lot of companies are reporting their profit data at the moment, that they've still got good profit numbers, but a lot of them are downgrading their future forecast because of this uncertainty. So I suppose the positive thing is that most forecasters are agreeing that we are getting towards the top of the interest rate cycle, talking about that peaking out within the next 4 to 6 months. So the message coming through is that it's important additions, but that earnings season has emphasized the importance of backing the right companies that can navigate through uncertainty. Good quality businesses, essentially, that have pricing power, that can dominate their markets, that have good margins. These are typically the blue chip companies, which is a real positive for Aussie investors, because a lot of them are still trying to figure out what to do with the cash that they've saved over the last couple of pandemic impacted years. But the challenge is really that, as I sort of touched on previously, that the rates haven't really bit in, and the unemployment could tick higher. So that could drag down on company profits and therefore share market growth. What it says to me is that you do really need to have a good strategy around your investments. Make sure that you've got your bases covered in the short term, so you're not going to be forced to sell your investments like you probably should at any time, but have your risk covered there and follow it through. If we do keep going sideways or down, you can always invest more. And the alternative to investing is sitting on the sidelines, which is really not going to move you any closer to what you're doing with your goals, particularly if you're investing regularly, if you're a net investor. So that means you're saving on a regular basis and then investing. Markets go down, you'll benefit. But if markets don't go down and you don't do anything, you'll essentially have missed the boat. So goes back to having a good plan, but the opportunity is all out there. And as I mentioned, definitely a lot of positive signs out there today. Talking property in Australia, and I saw an interesting piece last week from the AFR around the most expensive suburbs in Australia that are defying the property downturn. This is all based off CoreLogic data, where they looked at the top 2% of the property market and showed that the majority of these suburbs are still growing, and in a lot of cases growing quite strongly, even though the market is softening. So looking at some of the data there, basically median prices in the top 2 percentile areas range from $4.65 million in Sydney to $3 million in Melbourne, $1.9 million in Perth, and $1 million in Darwin from this CoreLogic data. In Melbourne, prices have risen by $30,000 to $3.1 million in the 12 months to the end of July. Whereas in Brisbane, they actually jumped by $350,000 over the same time period. In Hobart, though, hold on to your hats for this one, that their top-end suburbs rose by nearly 14% or $187,000 to $1.5 million. Sydney was a bit of a drag on this, though, that off the back of a 25% surge last year, the top 2% of the market went down or backwards by 0.2% or $8,000 in the 12 months to the end of July. But that shows me that these premium suburbs are really holding up quite well. Some of the suburbs, just for people of interest, we've got Cottesloe in Perth, Netherlands, Port Phillip, Bullara, Mossman, Stonington, Byron, Strathfield, Bayside, Canada Bay, and a bunch of other ones in there as well. So a lot of those suburbs, and definitely all of the ones that I've mentioned there, they have continued to grow. Some of the top 2% suburbs that have actually slipped a little bit. They were predominantly in Sydney. We've got the Northern Beaches, Willoughby, Randwick in Sydney, Boroondara in Melbourne. I hope I'm saying that right. Ku-ring-gai, Hunters Hill, and North Sydney. And North Sydney was actually the worst performer of the top 2% suburbs across the board there. So overall, quite strong. I think in Melbourne we saw. We've seen things like Edward Craven's $80 million buy of the Toorak dilapidated mansion. So showing that the higher end of the market is more resilient to downturns. And what I'm seeing from talking to the people that we're helping with their money, that the fact that premium suburbs and premium properties, there's less supply. These properties are coming onto the market less. So when they do come onto the market, they get snapped up quite quickly. That means that the prices are supported better. And I think the lesson here is that when you're choosing your property, if you choose good suburbs and good properties, you're going to feel a lot less of the fluctuations, which is, goes a long way to saving you stress, particularly in the current sort of climate. Talking though, and it's not all roses for the property market, we saw some data come out from ANZ last week predicting that property prices will fall by around 20%. This is the ANZ just did this massive housing report, and they have said that by the end of 2023, that they're expecting a decline of almost 20%, and that it's not just limited to the major cities. They say that the driver of this is a big increase between mortgage interest rates that we've seen over the last 4 months and reduced borrowing capacity. So that's what that's doing is it's forcing people to pay more, but then restricting their ability to refinance their mortgage, meaning that they're essentially locked in. They think that that's going to lead to price falls of 18% in 2023 by increasing late in 2024. This means that if it plays out in this way, it means that the median house price in Sydney could go down by $204,000, whereas in Melbourne took $128,000 and more than $160,000 in Brisbane and Adelaide by the end of next year. So they think that one of the big drivers, particularly that's going to slow down new people getting into the property market and contribute to a decline in property prices, is that the banks will lend less to people, because if people can't borrow as much, then they can't get into the market as much. So they're talking about the cash rate reaching 3.35%, which is probably not that far away from the consensus view. But what they think that's going to do is reduce borrowing capacity by nearly 30%, which is a massive deal. Paying a little bit more for your mortgage probably not the end of the world in the short term, particularly if it's a short-term thing, but being able to borrow 30% less, that's a big deal and going to have a serious impact on people's abilities to buy property. So my thoughts on this is that there's likely to be an opportunity there. I think that, as we just touched on, that premium properties will probably hold up much better than the broader market. So if there wasn't already a reason to choose smart, then this should be a sign for you. And I think that, yeah, it all goes back to your strategy, and really, really crucial in the current climate at any time when it comes to property, but in the current climate, that you're rock solid with your plan so that you're not caught short. A bit of an interest piece that I came across last week that I wanted to share was around because they've just got all the income and tax stats. There's some interesting data come out, and one of the pieces that I looked at was the highest income suburbs in Australia. So Peppermint Grove and Cottesloe in WA, who share a postcode, they've just claimed the title of Australia's highest income postcode at $325,343 annual average income, which I think is pretty staggering across an entire postcode. They've pipped Double Bay, who was the previous winner, and Double Bay has actually fallen from the first position in the income stats to 10th, with a relatively modest average income across that postcode of $170,000. Now, Peppermint Grove has had an 80% increase in their average salary, so $120,000 increase in the average taxable salary from 1920, which is a pretty amazing jump. Now, other suburbs that made it onto the list: Darling Point in New South Wales, Point Piper, Bellevue Hill, and Sydney's eastern suburbs. The only postcode in Victoria that made it into the list, interestingly, was Toorak 3142. And then they sort of drilled into what were the professions that made up this list. And surgeons were the highest income occupation category in the list. Then there's a bunch of medical professionals, financial dealers, and engineers that made up the top 10. Another interesting point that I got out of this is that CEOs have completely dropped out of the top 10, which I think is probably because of the fact of the rise of, we got this big upshot in the CEOs that are CEOs of a company of one. Personally, I know a few of these people, and I think it's a lovely job title, but maybe not appropriate for a single person company. But yeah, some interesting stuff in there. Talking interest as well, and coming out of the same sort of stats, we found that they released the data on the occupations that claim the highest amount of tax deductions, and politicians were the ones that topped the list. They claim more work-related expenses than any other occupation, which is claiming an average deduction of $8,974 each year. That compares to a fast food cook of $245 per annum, so $9,000 compared to $250, or a cashier at $364. The national average is $950. And in addition to the huge amount of tax deductions, the politicians, particularly, there's a big gap for federal and state politicians between their average income and their taxable income, which is $46,000. By far the highest amount of over 1,100 occupations that were measured. Probably drivers of this is the tax-free allowances for travel, deductible interest and rent costs on a Canberra residence if they want it, plus getting a free car on top, or a $20,000 allowance, even though their rent is deductible and the interest costs on the mortgage are deductible on a second property, which nobody else in the country gets. So look, a little bit questionable. And I suppose when you think about the fact that the government's looking for savings in their budget and talking about pilfering things like superannuation or tax rates and those sorts of things, there might be an easy win for them there. They have said that they feel like this doesn't meet community standards, but unfortunately there is no plans for them to be reviewing this. So maybe we need to send someone an email on that one. But there's probably some lessons there that we can take around making sure that you can take advantage of all the deductions that are there. But we've all got some catching up to do when it comes to the pollies on that one, I think. Now, a tactical one that I wanted to share for this week was around how to save $75,000 in tax when you sell an investment property. Now, I just put together this piece and I thought it was worth sharing here because particularly in the current climate, we're seeing a lot of people that are looking at restructuring things and setting up their strategy. So I'll run through the numbers on this one. Basically, if you'd bought an average property in Sydney in 2011, so 11 years ago, the median house price was $634,000 at that time. based on the long-term growth rate of 6.3% of the property market, today that property would be worth 1.265 mil, meaning that there's a gain of $631,000. Now, for a couple in Australia earning the average income of $90,000, you would each pay tax on that income alone of $21,000. But when you add in the total capital gain on that property, so $631,000, split it in half for the couple, apply the 50% long-term capital gains tax discount. Basically, the assessable gain attributable to each person is an extra $157,000. Now, when you add that onto your other salaried income of $90,000, that brings your ATO assessable income to $248,000, and the total tax per person would be $87,631. So basically, an extra $66,000 in tax. Now, if you're earning $90,000, your employer would be making compulsory super contributions on your behalf of $9,400 per year, but the limit for concessional contributions is actually $27,500. What that means is that you've got room to make an extra contributions to your super fund of $18,044 in the current financial year. But for a couple, contributing at this level would reduce your taxable income to $230,000, meaning that your tax bill would go down to $79,000 or reduced by $8,481. So just stepping that back, basically contributing an extra $18,000 to your super fund would save you $8,500 in tax. But it can get even better because a few years back, the government introduced the ability to use these catch-up super contributions, where if you've got less than $500,000 in your super fund and you haven't contributed up to your concessional contribution limit in the current financial year, you can catch up on those contributions. So that means that someone receiving contributions, the total unused contributions at that level would be $82,000. So if you put $82,000 into your super, the total tax payable reduces to just below $50,000, or meaning that the personal tax saving for the couple is $75,350, which is a serious amount of extra cash that can be directed to your wealth building or other money goals. And this really highlights the difference between good and great when it comes to your planning. Now, tax makes a big difference here, so you've got to use the rules to your advantage. Obviously, pretty complicated, so I'd suggest getting some good advice here, and that was not financial advice, but gives you some insight as to what's possible. If you think that's something that could work for you, then I'd suggest doing your research and potentially getting some professional help. Guys, that's it from me for this week. I hope you enjoyed that. I'll catch you on the next one. Bye for now.